versus buy. If you all notice, on the tables in front of you, you have a handout that you can reference. Review it quickly. I'll give you a moment. If you had to make a decision in 10 seconds, what would you do?
Please.
Go.
Buy. Sell.
It's an easy decision for most people. They know they're on one side of the fence or the other. But why? Fellow Toastmasters members and most welcome guests, don't make that decision just yet. Let me share with you a little bit about how leasing got a bad name. First of all, I think we can all relate to the fact that when you go out and buy a car, it's got to be one of the most least pleasurable experiences that you could ever go through. No one likes buying a car. Not even car salesmen like buying cars. So why? Especially leases. I think it's because there's more fine print. There's more of an opportunity for you to miss something. There's more of an opportunity for them to get something by you and make more money. So let's review a few of the things that are in the fine print with a lease. Have you heard of an early termination clause? They can really get you with that, especially with this item here, residual. We'll get to that in a minute though. The other thing that is an interesting fact about the early termination clause is gap insurance. And the reason why is if your car gets stolen or totaled, that's an early termination of your lease. So are you paying your way out of that? What if the residual value, which is, let's review that now actually, the residual value of a lease is at the end of the lease, what will the car be worth, which is predetermined at the beginning of the lease. So for a $23,000 car, there's an $11,000 residual value after 36 months. So therefore, you could be responsible for the gap between the residual value and the remaining part of the lease. Because the leasing company didn't tell you that you could wreck the car and then not pay the rest of the money. They want paid. And the insurance company is only willing to give you what the car is worth, not what's left on the lease. So gap insurance is something that covers you from the gap. This is exactly what it says it is. Sometimes that's worked into an early termination clause, but not always. You've got to be careful about that. Insurance costs could be higher. With a lease, there's sometimes certain requirements on the amount of coverage you have. Limited mileage. My friend Todd, he's got a lease. He's got a Mercedes. It's nice. I'm always driving everywhere. He can't drive any miles. Wear and tear. Within reason, you're only allowed to put so much wear and tear on a vehicle. So if you tear a seat, if you happen to smoke and you decide to burn the roof or something, don't ask me how you do that, but for some reason it always seems like smokers burn their roofs. It's really weird. I'm not a smoker, but each their own. Creditworthiness. If you don't have great credit, you might not get approved for a lease. There's something called the money factor, and this is one of those areas that's a little bit gray. It's not quite an interest rate, but it kind of is. It's determined differently. It's not necessarily locked in much like an interest rate would be. And you really need to figure out, what does the clause read in your lease? And then the undisclosed acquisition fee. Donna, you've leased a new car. Congratulations. I'll take $600 now for processing this paperwork. That would be your undisclosed acquisition clause. And the extended warranty they try to offer you. You have a 36-month lease. There's a manufacturer's warranty of 5 years. Ryan, would you like to buy the extended warranty? Okay. Now, some of the benefits. You have a lower monthly cost. As you can see, it's $366 rather than, or $388 rather than $669. There's a lower capital outlay initially, so you don't necessarily have to spend as much on your taxes, on your fees, on your down payments, things of that nature. You don't have to worry about maintenance, which is really nice because you're not going to have the car long enough where it'll be out of warranty. So the only thing you're really going to have to handle is regular maintenance, not major maintenance. So the other nice thing is you get new wheels all the time. Your lease term's only going to be 3 months. You're always going to be driving a new car. And it's not as long-term as buying. If you decide you want to move to Alaska, the cost of transporting your vehicle there might be prohibitive with what it's worth. But then again, buying a vehicle in Alaska could be pretty expensive too because the car companies have to ship it there too. Not to mention you can't drive very far all the time in Alaska. So with buying, some of the negatives: maintenance, depreciation, more cash up front. Most of us are familiar with the buying process, so I'm not going to go into as much detail with it. Some of the positives: you own an asset. There's not as likely to be some crazy fees and fine print that really make you feel like I really got taken advantage of in this process at the end of the process. Because normally when you're in a lease, you don't really realize you got taken to the bank until it's too late and it's 3 years later. The nice thing is, it's yours. You can drive it as much as you want and for as long as you want, as long as you still make the payments. And then after you pay it off, you can keep driving it. It's not one of those things that ends in 3 years. So let's review the math real quick and just take a quick look at what it looks like to lease versus buy. So if we made an identical car purchase, a car that was worth $23,000, a $1,000 down payment with an interest rate of 6%, this isn't really an interest rate, this is a money factor, which is a little different, but for the sake of simplicity, we'll stay away from that. Something to look at though if you do want to seriously think about leasing a car. So the residual value after the lease is over, the car is worth $11,000. You have the option, most of the time in an open lease, to actually purchase that vehicle for $11,000. Another thing to look at is what kind of fees are associated with that. Sometimes at the end of the lease, yes, you can buy your car for $11,000 and it's all yours. Which would be really nice, because if you think about it, if you do the math, your car here that's said worth $11,000, if you drive it the same amount here after you purchase, you haven't paid your loan down where you only owe $11,000. So you're making this larger payment and you're still not down to $11,000. So that being said, I think I might have said that incorrectly. I did. Once you make all your payments, the car's paid off. It's kind of yours. So, in conclusion, what you have here is a choice before you of, do I want a new car all the time? Am I in it for the long term? I won't tell you to lease or to buy, but I can definitely tell you it's a personal choice. Madam Toastmaster?
All right.